Welcome back. I just want to do a quick update on NVDY for NVDY fund holders to see what they're holding. Today is 6/30/2025, so these are the holdings for NVDY for the week. In order to see this, I guess first of all, NVDY, you can see here it's part of Group B. There we go. Some somewhat recent price is $16 and change. Recent dividends 67 cents. That was a 4.03% return on the month. Cumulatively, since fund inception date, it's paid $31.68 and it's produced a total return of the cumulative dividend plus the ETF price currently at $48.34, which is a percent return of 141%. As far as NVDY metrics, since inception, those can all be found here. For example, dividend history, and then as well as the price plus the cumulative distribution over time. But diving in depth into what the fund is currently holding, if you click the NVDY in depth, here is the, fund holding spreadsheet from the YieldMax website, unedited. In order to see this in more visual, appealing terms, I've modified a code that takes it and puts it in some more appealing format for someone to digest. But here's a quick overview. Market cap looks like NVDY, the underlying equity, and NVDY has been on a roll lately, therefore pushing the fund market cap over 1.7 billion. Shares outstanding have been increasing steadily with a slight decrease lately, but the overall trend is shares outstanding keeps increasing as people continue to invest in this fund given its strong performance metrics. As far as what the fund is holding right now, here's overall. It's got 1.5 billion in cash. The synthetics were 228 million. And then it's currently got contracts sold net of negative 23 million. What that means is they sold contracts using their synthetic as collateral. Assuming the underlying equity does not hit the strike prices sold, the fund should collect the 23 million in premium, as this acts as a negative account on the value right now. But if assuming no expiration, or assuming no strike prices are hit expiration date, the 23 million will go into the total fund value, and this would increase by roughly 23 million. On a per share basis, the magnitudes look the same. On a per share basis, we got 14.77 in cash and 16.74 as the total ETF price, with $2.19 of synthetic value, and the other contracts, which should expire by the end of the week, coming at 22 cents per share. In terms of how the synthetic is used, there are a total of 112,640 contracts that are owned via the synthetic. They are in two different strike prices. There's one at 130 and 146. I got that visual on another screen. But of the 112,640 contracts, they've written calls, or they've used all that collateral to write calls. So they've written calls against everything so they've written a total of 102,640 short calls, but they've also bought some calls with higher strike prices on that entire amount. So they've also got 112,640 calls bought at strike prices higher than what were sold. So in essence, they did 100% composition of credit spreads that they sold. They sold no just short call options. They only sold the short call options with the higher strike call also purchased. So therefore, they shorted a credit spread using their synthetic as collateral. So therefore, I say they got 100% insurance percent. They got 100% insurance on their positions. As far as what these look like, here's a breakdown. You can see at the bottom here, I got the underlying equity price, or not the underlying equity price, but the underlying equity price in this version acts as a strike price. The black line is basically the stock price as it was recently clocked. The synthetics, you can see they got one at 146. If I click here, they also got one at 130. So they got the stock price is well above the synthetics, which therefore gives the synthetics a pretty substantial value relative to the fund overall. So let's break this down. So currently they've got the 155, the 157.50, and the 160 call contracts sold. In magnitude, the 160 is the most, followed by the 157.50, and then the 155. As of the last time I clocked NVIDIA's price, it was $156.70. Therefore, it has already surpassed the 155 strike price that they sold here. So gains on 19,150 contracts of the synthetic are already capped. That said, they also have insurance at 162.50, 165, and 167.50. The total shares that they bought should equal the total shares that they've sold, given 100% insurance breakdown. On a per share basis, or I guess this here just shows percentage, which is basically the same. It shows magnitudes in terms of the total percentage. For example, at the 160 strike, they got 43.32% of their contracts sold. That's the strike price they have them set on. This gives a market value comparison, but as a per share basis, market value per share, you can see they've already passed the 155. That currently actually has almost a negative 8 cent lag on the fund. Currently, the 157.50 is acting as 11, almost 12 cent lag on the fund. If the stock price were to stay underneath that, the fund would increase by almost 12 cents, as that value would go to zero at expiration date. Then we also have the 160 is a negative 7 cent lag, and then you can see the insurance contracts. These boost the fund, I guess, 2 cents. That's it. If they don't hit by expiration date, they effectively go to zero. I got some other views in here. These are on a percentage basis or a market value basis. And then I finally have just, these are the values that the synthetic will go up, assuming. So if the synthetic does hit the strike price, the overall synthetic value will increase. As said, it will be capped out once it passes it. But you can see there's still gain remaining, assuming the synthetic hits it. So even though we got some contracts sold at 155, as a fund holder, we still want the fund to go up because we got a portion of the fund that will keep increasing until it hits those future strike prices. And then assuming it hits all of the strike prices, since we got the insurance, maybe I should go back. So even if we pass the 160, we are capped. Our gains are capped past 160. However, once we hit 162.50 or 165 or 167, we recapture the ability for the fund to increase in value as the underlying equity increases. So that's a nice part of credit spreads. You're capped out for a little bit, but you can regain exposure as you pass the call option of your credit spread that you sold, or the call option you bought of your credit spread. But so overall, that's the breakdown of NVIDIA currently to start the week. We'll see how the fund ends up. But thanks for tuning in.